Hello, America. I'm Camille Chandler, and this is Qualitative Listening. In an episode earlier this week about rising Treasury yields, we brushed over the impacts of the 10-year on mortgage rates. Well, on this episode, we're going to dive deeper into that, specifically the 10-year Treasury yields impact on mortgage rates. Later on, we're also going to discuss Jerome Powell's speech today, which might give us insight into June rate cuts. But first, as always, let's go over the Treasury yields. The 3-month is at 4.37%. The 6-month is at 4.26%. The 2-year is at 3.97%. The 5-year is at 4.06%. The popular 10-year is at 4.45%. And the 30-year is at 4.91%. Today, like I said earlier, we're going to highlight the 10-year. The 10-year Treasury yield impacts mortgage rates primarily because it reflects the broader market's expectations for interest rates, inflation, and economic growth, all of which influence the cost of borrowing. Here's why the 10-year yield is so closely tied to mortgage rates. Number 1, benchmark for long-term loans. Mortgage-backed securities, which fund most mortgages in the U.S., are long-term investments, and the 10-year Treasury is the closest risk-free equivalent in duration and behavior. Investors use it as a baseline for pricing mortgages. Number 2, investor behavior. When the investors buy Treasuries, demand drives prices up and yields down. Lower yields equals lower returns for investors, equals lower mortgage rates to stay competitive. Conversely, when the yields rise, lenders must raise mortgage rates to attract buyers for their mortgage-backed securities. Number 3, risk premium. Mortgage loans are riskier than treasuries due to borrower default, prepayment risk, etc. So mortgage rates include a spread over the 10-year yield to compensate for this risk. As the 10-year yield changes, mortgage rates adjust to maintain that spread. Number 4, expectations for the future. The 10-year yield reflects investor beliefs about future Fed rate policy, inflation trends, and economic health. Since mortgages are long-term, lenders price in those same factors. If investors expect rates to stay high, both Treasury yields and mortgage rates will rise. In short, the 10-year Treasury yield acts as a signal and anchor for the mortgage market. It's not the only factor, but it's one of the strongest. Alright, that's the show, folks. Thanks for listening to Qualitative Listening.